Good morning and welcome to the sixth session of the Pinnacle 2020 Virtual Summit. I'm Matt Dell. Our topic today is alternatives and emerging strategies. Alternative investment strategies can provide returns in both rising and falling markets. The institutional market generally invests big in alternatives. We see 20% of the future fund portfolio invested in alternatives, infrastructure and timberlands, for example. With elevated equities valuations and interest rates and bond yields at record lows, traditional portfolio diversifiers aren't achieving the returns anymore. So investors need to look for alternative sources of risk and returns. On emerging strategies, studies have shown that strong outperformance can be achieved by accessing early stage investments that are nimbler and more focused on achieving critical success. Today, we have four speakers, two of which will be discussing alternative strategies and two discussing emerging strategies. Each speaker will present their ideas for 15 minutes each. Then our moderator for today, Zenith's David Wright, will host a Q&A session with the panel of presenters where you'll have the opportunity to ask questions. Okay, before I introduce our portfolio managers, a couple of quick housekeeping items to ensure you get the most out of today's session. Our Digital Summit webinar platform is fully customizable. You'll see a bunch of icons at the bottom of your screen, which will enable you to access further information such as download presentations, explain how to access CPD hours via our CPD partner portfolio construction forum, and of course, ask questions. You can also access further information on the great community work of the Pinnacle Charitable Foundation. We're excited to announce that any donations we receive during the summit will be doubled by Pinnacle up to a total of $10,000. So let's begin. Our first two speakers will be talking about alternative strategies. First up is Patrick Hodgens. Patrick is Firetrail's Managing Director and Portfolio Manager for the Firetrail Absolute Return Fund. He's a 34-year veteran of equity investing, having spent 28 of those years at Macquarie Bank before founding Firetrail in 2018. Today, Patrick will talk to us about how you can invest in how you can achieve equity-like returns with no effective exposure to equity markets. Patrick, welcome to the program.
Great, thanks Matt, and good morning everybody. I have to say this photo really does remind me of the equity markets, those huge peaks followed by those deep troughs or those deep valleys. The one big advantage of investing in an alternative approach is it effectively smooths out those peaks and those troughs. So when you're trekking through the mountains or navigating the equity markets, it's a much smoother, a more gentle, and a much more enjoyable investment journey. Today's presentation will illustrate how you can actually smooth out those extreme equity market moves by utilising an alternative investment strategy. And there's three key messages here. Firstly, the market conditions. Where are the opportunities, but also where are the risks and how are we managing those? The second one, we believe now is the time for alternatives to supplement your equity exposures. And then finally, we'll talk about the Firetrail Absolute Return Fund, which is a market neutral fund that provides consistent alpha, but most importantly, it smooths out those deep valleys, if you like, that keeps coming up with the equity markets. It really is a proven alternative. Now, the coronavirus is obviously from a health and well-being perspective incredibly distressing, but selfishly from an investor standpoint, it really is a 1 in 10 year opportunity to add value for our clients. And we're incredibly excited about the opportunities right now in the markets for two main reasons. The first one is this share price dispersion or cross-sectional volatility. When it spikes up like it is doing through COVID, more opportunities, there's more alpha opportunities out there. And it's not dissimilar to 2012, 2008, the GFC, and even if you go back to 97 and even earlier than that. High share price dispersion leads to more opportunities. And that's great news for a concentrated bottom-up stock picking manager like us at Firetrail. The second opportunity is the number of recaps because of COVID. Already there's been $30 billion raised in the last 5 months. But if you go back to the GFC, there was $100 billion raised by 100 companies over a 2-year period. And the GFC really prepared us for this COVID recapitalizations we've experienced in the last 5 months and will experience going forward. But the key point about both of these charts here is, do they continue as they are, or do they revert back to more normal levels? We're firmly of the view that these both continue, particularly share price dispersion. When you look at all the macro uncertainties out there now, we've got the US election coming up, we've got no vaccine yet, we've got fiscal stimulus will need to be wound back at a point, and clearly trade wars are getting worse, not better. So we think that this will continue to spike in the next 12 to 24 months, and that's great news for stock picking managers like us at Firetrail. And then you look at the recapitalisations. Remember the GFC, $100 billion, 100 companies over 2 years. So far, we've raised $40 billion and around $30 billion in around 40 companies. So it's fair to say we could only be around a third of the way through. But a word of caution there, the easy money in these recapitalisations have already been made. Same as through the GFC, the early recaps were the easy ones. It gets harder from here. There's a lot more alpha opportunity, but at the end of the day, it'll be more difficult. So you do need to do that deep dive research. But the key point is the story here is really only in its first chapter. So increased volatility, increased corporate activity is leading to more opportunities out there. But with opportunities, heightened opportunities, comes heightened levels of risks. So there's three key areas at Firetrail that we're constantly monitoring for our clients. The first one, top left, is effectively the market timing risk. Right now, the market is pricing in effectively a V-shaped economic recovery. But hey, we're in a global recession and the unemployment rate is 8%. It seems a bit extreme to me. What we do at Firetrail is we never try to time the markets for any of our products. And the beauty about the Firetrail Absolute Return Fund is we eliminate or strip out all of the net market exposure effectively on a daily basis. So pleasingly, when the market's down 21%, as we saw in March, we don't see that. But being aware when the market's up, say 10%, we also don't see that. We have no correlation to the equity market. So risk number one, we've effectively eliminated for this fund. Risk number two, or broad risk number two, is there are pockets of the market now where there's extreme market valuations or high valuations. This chart sort of indicates it in a little way where you've got high growth companies trading at around 2.5 times low growth companies. Historically, it's been around 1.6 times. Now, low interest rates today, it does make some sense that these growth companies have spiked up, because clearly a growth company that is providing sustainable and growing cash flows well out into the future are worth more today when interest rates are low than they were worth 2 years ago. But to me, it is a bit extreme. The markets do move in cycles, and going all in on high growth companies, we think heightens the risk for the end investor. So we always have a balance of both growth companies as well as value companies. So we don't eliminate that risk, but we can reduce it quite significantly. And then you have all the macro risks, which I mentioned a little bit earlier, and I won't go through these in any detail at all. But effectively, there are a lot of headwinds facing us. What we do at Firetrail is try to understand these risks and detune our portfolios as much as we can. We want to be aware of all these risks, we want to understand them, and we want to reduce the binary nature as much as we can and just let the stocks do the talking. Risks are elevated, as I mentioned, so now is the time to look for alternatives to supplement your equities exposure. It provides stability, it provides alpha, but most importantly, it provides downside protection. Now, we know the equity markets have been on an absolute tear since around the 23rd of March this year, both domestically as well as globally. And a lot of that makes sense because we've got interest rates incredibly low, we've got very easy monetary policy, we've got very strong, if you like, active fiscal stimulus globally, and there's limited other investment alternatives out there. So the demand for equities has been insatiable since March. But the question you need to ask yourself is equities, have they actually run too far? I mean, at the end of the day, we are in a global recession. We have unemployment rate of around 8% globally, but most equity markets around the world are hitting their all-time highs. It doesn't resonate. And then you've got your traditional alternative to provide downside protection being the global bond market or domestic and global bonds. Sure, they still provide downside protection, but with yields pretty close to zero, there's not much alpha opportunity there, which is why it's forcing a lot of our investors to look for alternative investments to both add alpha, but most importantly, to detune their equity market risk or exposure. Now, many are going into physical gold and gold miners, and Ray Dalio from Bridgewater commented on that last night. And that makes sense for diversification. It's a great diversifier away. However, it's quite illiquid. Many others are moving into credit funds or agricultural funds, macro funds or ESG funds. And again, they're all worth considering because it does provide you that diversification. But sometimes at Firetrail, we think the best solution is the simplest solution, and it's the one staring you in the face. It's a truly labelled market neutral fund. But all of these alternatives supplement traditional asset classes. Now, if you've decided to move to an alternative investment approach, the first thing we believe you need to look at is what is the correlation of this alternative product to traditional asset classes? There's no point investing in an alternative asset that has high correlation to equities. You might as well invest straight into the traditional asset class in the first place. So you want low correlation across as many traditional asset classes as you can. What we have here is the Firetrail Absolute Return Fund correlation across every asset class we can find. We also included one of the more popular alternative investment approaches, Winton Global Alpha. And as the chart highlights, there's almost no correlation to anything. 0 to Aussie equities, very low, 0.2 to global equities, none to global bonds, none to Aussie bonds. We have no correlations, which provides significant diversification from traditional asset classes. So once you've decided on an alternative approach where there's low correlation, clearly it's about performance and it's about risk management. So what we have here is the ASX 200 total returns over various periods since inception of the Firetrail Absolute Return Fund. In the green, which will be up in a moment, is the total return after all fees that has been achieved by the Firetrail Absolute Return Fund. As you can see here, it has absolutely no correlation to the equity market. Market up 10%, we will not see that. But most importantly, through March, market down 21%, we also don't see that. And it's probably worth to reiterate that looking at the calendar year to date, because that's sort of the full history of COVID. We obviously had announcements of COVID in early January, the market ignored, panicked in March, and then the equity market rallied in April, May, June and July. But still, the ASX 200 is down around 8% year to date. Our fund is up 12%, so a 20% differential, absolutely no correlation to the equity market at all. And if we brought it forward to this month alone, the equity market is still down another 2%, and our fund is up around 3%. Now, you may say this is a fairly short track record. We've only been in existence at Firetrail for 2.5 years. But if you go back to our history at Macquarie, where we ran exactly the same type of product for 15 years, the profile is exactly the same. It provides zero correlation to equities. It provides solid alpha consistently, but particularly through market dislocations. And you're getting that for a lot less risk than the equity market. It really is a proven approach to add alpha and reduce equity risk. So why is the Firetrail Absolute Return Fund unique and very different to many other players out there in the market? The main reason it is a true to label market neutral fund, and that will make sense by the end of this presentation. But the other key difference is that it effectively has 4 levers to add alpha, but it's the proprietary risk engine at the back end, that secret sauce that reduces all the net market exposure and all those nasty macros, all those thematic issues. How we actually invest the fund is a client invests $100 in the fund. We then go and find $200 of stocks we expect to outperform over the medium to long term. We've got 2 levers here. Lever number 1 is the high conviction fund. We are not reinventing the wheel here. We've got an outstanding team, a great process, great philosophy and a long-term track record. So whatever hits the high conviction fund will go into the absolute return fund at the same time. So right now we've got Qantas, we've got Seek, we've got Lendlease in the high conviction fund. We've also got those in the absolute return fund. The key point though is we need a good balance of growth companies as well as a good balance of value companies. The second lever is in that small company space. So mid caps, small caps, micro caps, IPOs and pre-IPOs. There's an enormous amount of alpha to be added there. And because the liquidity is not there, the volatility is not there, and generally they're quite small, they don't necessarily hit the high conviction fund, but there's a lot of alpha there. So we have a very good small cap team that source out those opportunities. So right now we're in Sea-Link and Megaport and Chorus and Kathmandu. There's an enormous opportunity set in that area. We then go and short $200 of stocks that we expect will underperform over the short to medium term. The third lever is what we call fundamental shorts, and it's a very simple approach. If there's an earnings downgrade risk, it's an opportunity to short that company. But I might spend a minute or two on what we actually don't short, because this is where most of our peers get into trouble. We never short just because of valuation, because over the last decade, companies can remain expensive as long as management deliver or over-deliver in terms of earnings. At the end of the day, share prices follow earnings. So you have to spare a thought for the managers and their clients that thought Afterpay was expensive at $5 or WiseTech was expensive at $6 or Tesla was expensive 1,000% ago. At Firetrail, we'll never short because of valuation. The second thing we never short is we never short market themes, whether they're true themes or whether they're fads, whether we get a vaccine today or tomorrow, whether online retail beats offline retail, or whether the Financial Royal Commission, who are the winners and losers. They're binary outcomes, and the risk versus return reward is just not consistent enough for us to short themes. We're very simple. We short because of earnings risk. It might be a new company coming to a new business, chasing market share and reducing margins for everyone. It might be raw material increases, or it might be labour increases, or revenue falling for any reason. If there's an earnings risk, it's a candidate to be a short for this portfolio. And in FY20, there was over 200 shorting opportunities. So at Firetrail, we are never short opportunities. The fourth lever effectively brings it all together. So levers 1, 2, and 3 are all about adding alpha. Lever 4, yes, it still adds alpha, but really what it does is that secret sauce, is that proprietary risk algorithm that eliminates the net market exposure and reduces all those macro or thematic risks back to levels that won't hurt the portfolio over the medium term. So we have 4 levers, all add alpha, but it's that secret sauce that reduces that risk quite consistently. And this is what the fund looks like any day, any week, any month, or any year. $200 worth of stocks we expect to outperform, and $200 of stocks we are shorted that we expect to underperform. Market up 10%, we won't see that. Market down 20%, we do not see that either. But the risk short algorithm is really the secret sauce. It really expands and contracts whenever we move the portfolio around. So September, October each year, when there's not a lot of fundamental shorts, we close them out post results. They'll automatically contract, and that risk short algorithm will expand and take up the slack. The opposite happens in December, January, and February. More fundamental shorts, therefore that risk short algorithm reduces through time. Always our longs equal our shorts, and as long as our longs outperform our shorts, we deliver on objectives. It really is one of the only true to label market neutral funds in the Australian market today. One of the last things I'll touch on is, yes, we've had a very good financial year today, or calendar year to date, but there's an enormous amount of predicted or embedded value in this portfolio today. What we've done in the last 10 years is try to estimate the portfolio opportunity or the alpha opportunity, but it is a snapshot, and obviously the market's incredibly dynamic. But if you look on the far right-hand side, the average embedded value we've had over the years is around 17%. Right now, we have over 33% of embedded value in this portfolio. So it's significant in the current portfolio. So thank you for your time. 3 key messages is the opportunities out there at the moment are abundant, but so are the risks, so you do need to tread carefully. Now is the time for alternative to supplement your equities. It provides alpha, it provides stability, and it provides, most importantly, low correlation to the equity markets. The good ones provide zero correlation. We believe the Firetrail Absolute Return Fund is a very good one. It's a market neutral approach that adds consistent value through time. It really is a proven alternative. Thank you.
Thanks, Patrick. And remember, you'll have the opportunity to ask questions of Patrick and our other speakers in the Q&A at the end. Our next speaker is Michael Blakeney. Michael is the Managing Partner and Chair of Riparian Capital Partners, a specialist manager of water, agriculture and food production assets. Michael will talk through the attractive risk-return profile of water assets and the very low levels of correlation to traditional asset classes. Michael, welcome to the program all the way from Brisbane.
Thanks, Matt, and morning. I'm always somewhat bemused when water is classified as an emerging asset when you consider throughout most periods of civilization, water's been recognised as a fortress and essential asset. And while it historically hasn't been valued in a financial sense, it's certainly been valued in a defensive and strategic sense. Now, I admit it has been typically challenging to source investments that leverage water, aside from some infrastructure or utility type plays. But Australia is quite unique in that it has an established and successful water market framework, which, unbeknownst to many, and despite the noise you may see on media occasionally, is viewed as a global leader in sustainably managing our scarce water resources. So it's this water market today that I'll talk about, and I'll talk about how Riparian sees value across this market to construct an uncorrelated investment strategy to deliver consistent yield and capture capital growth across this unique set of assets. Now, the Australian water markets have developed into one of the most sophisticated and functional water markets in the world, and this took decades of debate and argument and discussion and a lot of legacy issues to sort out from all sides of the community. But they are considered by many to be the gold standard. Our water markets have endured a range of climatic, economic and political cycles over the last 12 years, and they've demonstrated resilience throughout those changing times. The fundamental drivers I'll talk about today that provide strong tailwinds to water are unrelated to those that drive traditional asset classes. So that leads to a logically low level of correlation with traditional investment strategies. We see water as the irreplaceable input into irrigated farmers, with farmers requiring water every year, even when it's wet. So La Nina periods like we're moving into at the moment don't fundamentally change the outlook for water. So this allows investments in water entitlements to generate reliable annual yields, which is a key attribute of this asset class. They've proven to be relatively stable and they haven't shown any signs of compression to date. A question that often comes up, and we'll touch on it a bit later in the presentation, is what about the regulatory framework? And that framework continues to evolve, but the fundamentals of those regulations have remained stable, again, through a variety of cycles, both political, economic and commodity, since the markets were broadly established over 12 years ago. Just to try and get you to understand a bit better, which is sometimes a complex theory around water. We think it's really quite simple, but we've been investing in this sector for decades now. So for us, it's central to everything we do. But when we talk about water in Australia, we're really referring to two specific assets: the water entitlement, which is the real asset, and the water allocation, which is the annual yield generating component. So the water entitlement, that long-term in perpetuity right or property right, is really permanent airspace in a dam. And each of these permanent airspace has a different security class. So if you look at the bottom of that slide, you'll see the bottom of the dam is high security, the top of the dam's the lower security. So in wet years, you'll have water all through the dam. In dry years, you'll only have water in the bottom of the dam. Water allocation is the amount of water that airspace contains each year that we then are available to use, to sell or to lease to farmers. Investing in water at a high level really involves, quite simply, buying a portfolio of these permanent water entitlements, and that's across the Australian irrigated sector, and then either leasing those entitlements or selling the annual allocations to irrigators to generate the income which drives our yields. Now, the farmers we sell that water to use it to support the irrigated operations, and really importantly, the volume of water entitlements on issues is capped as a result of the reforms that I touched on earlier. So this means there's a limited amount of water available, i.e. they're not issuing any more lot rights. So the amount of water rights on issue are capped, and they've actually been decreasing over time as government buybacks have been in place to support a more sustainable diversion limit. So given water's position as a vital input in irrigated farming, there's strong competition against the users to secure these resources to support their operations. So what that means is if you've got two farmers both requiring water, the farmer that can make the most money per unit of water allocated will outbid the other farmer for that water. And so what we'd like to say is simply water flows uphill to value. Now we break the fundamental drivers of water entitlement into two key areas: long-term and short-term categories. These long-term drivers are productivity gains by farmers, increasing commodity or agricultural commodity prices, increased demand for water, and in addition, that reducing supply from climate change impacts and government buybacks I talked about. Now, on the other side, the main short-term driver we see is changes in seasonal water supply conditions, so whether it's raining or whether we're in drought. And as you can see from that chart on your screens, these long-term drivers have resulted in strong gains along the way, which really leads us to the next slide around what's the performance been since 2018. So the returns here are based on a basket of the major Southern Murray-Darling Basin water entitlements, which is where the majority of the trade takes place. And as you can see, the returns have been strong with capital appreciation of around 8% annualised over that period and annual yields around 4%. And these yields in particular are one of the key attributes of water entitlements that we think make them particularly compelling in today's low yield environment. And we see plenty of reasons as to why those yields can be sustained in the future. On this slide, you can see the long-term drivers of those water entitlements and a bit more value and what the trends have been. So since 28, areas being planted to higher value, often permanent crops like almonds, citrus and table grapes, have resulted in increased annual demand for water, which according to ABARES has risen by over 3% per year. If we look at our commodity prices, our farmers have been receiving prices for their products that have increased by over 6% per year, according to Rabobank. And again, according to ABARES, our farmers have increased their productivity by almost 2% per year. At the same time, water supply situation has been impacted by factors including those government buybacks, which have occurred from 2008 and have actually reduced the volume of water entitlements available for farmers to use, and also by climate change, which has led to lower levels of inflows into the river. So to summarise that slide, demand's been rising while supply's been falling. Sorry about that delay. So this next slide really talks about supply-demand dynamic, and it's really illustrated here by the fact that those green vertical bars you see, that shows the annual demand for water in the Murray system by horticultural crops. So this is tree crops that I talked about. Now the interesting point is since around 2015, there's been significant areas, particularly in the southern basin, planted to higher value, often permanent crops. So that's the almonds, the citrus, the wine grapes, the table grapes we've talked about. These sort of crops can take up to 7 years to mature, and as they mature, they require increasing amounts of water each year. And this is expected to drive the demand for water in the southern basin even higher over the coming decade. And that's illustrated by those dark green bars to the right. Now, a drought year, the supply of water in a drought year is represented by that middle grey line, and an average year is represented by that yellow top line that you can see. So it's quite clear to see at some point in the next decade, we're actually going to be in a position where the amount of crop in the ground is going to demand a larger percentage of water than is able to be supplied. So that really puts this underlying demand on these scarce resources. It's also created what we call a permanency of demand for water, as these crops require water every year. When you've got an almond tree that's cost $30,000 to $40,000 a hectare to establish, and it's got a 25 to 35 year life, you can't afford to not water that crop every year, regardless of the price of that water. So far less flexibility in that system, as you can see, compared to 10 years ago. And we don't think that this tightening supply and demand dynamic is fully priced into the water markets yet. Again, supporting that rationale for why we think now is a good time to invest in water entitlements. As I talked about, the drivers are all related to the agricultural economy, whether that's agricultural commodities, demand, productivity, supply issues. They're not correlated to traditional markets. And as Firetrail explained, really no correlation in this strategy either to those markets. You can see negative correlations across. So quite simply, water markets are driven by how much farmers are willing to pay for water, again, unrelated to the drivers of traditional investment markets. We'll get to that next slide. So if we look for the outlook ahead, we're reasonably bullish around the trends driving these water values into the future. We're continuing to see increased areas planted to high value permanent crops, which again increases that annual demand for water on a permanent basis. We continue to see strong demand for Australian grown produce, despite the current tensions with China over certain aspects of our trade. We continue to see productivity improvements as our farmers are fully incentivised to continue to deliver on the gains we've seen over the past 4 decades. Finally, we see supply reducing, as I talked about, as a result of both climate change and government buybacks that have been implemented. So we talked a bit about the capital growth drivers. I'll just quickly touch on what drives our yield profile. And if you can see on the right-hand side of that in the light green of that diagram, what we do is with our portfolio of water, and again, this is a portfolio from the north of Australia to Tasmania that we're building. We sell, we lease, we build long-term risk management tools for growers that they then buy off us, and that's how we generate annual income from that portfolio, which in turn we distribute to investors on a biannual basis. Regulatory risk has been a topic of discussion, and we often see regulatory risk become more prevalent in the media, at least during dry periods such as the one we've just been through. The regulations have been well established now for over 15 years. While we admit that there's always room for improvement, we encourage that improvement. The framework has been supported by a range of reviews, as you can see on the slide there. So we've had reviews from the Productivity Commission through to state governments, through to the most current review, which is the ACCC review, which released its interim report in July. Now, that report highlighted the importance of water markets and the value that they have created. It also confirmed the important role that investors play in the function of those markets. The report pointed to areas where market infrastructure could be improved, and that's areas around governance and oversight and transparency and access to trade information. And Riparian contributed to that report, and we support the outcomes and recommendations to date. Hopefully that report starts to allay potential concerns some investors have around regulatory risk. The key other risks that we see across the market really relate back to that agricultural economy, some of that regulatory risk we talked about, and the climate risk. In our view, the ag economy remains strong, and demand for food both here and abroad is expected to support this. We see climate change is actually supportive of that underlying demand profile on water entitlements, and we think volatile weather events actually have more of an impact on the short term rather than the long term. And as we noted, the regulatory risks, in our view, have been significantly reduced with that recent ACCC report. So in summary, we believe water entitlements can provide investors with exposure to the broader Australian irrigated agricultural sector. And the beauty of water is it allows exposure, an efficient exposure, to an entire range of different commodities and the operators who produce them. Investments in a portfolio of water entitlements can provide an improved liquidity profile when compared to some of the more traditional land-based agricultural investments you might be familiar with, and that's because water is tradable, and the level of turnover of water is quite significant in itself. Having different types of entitlements in the portfolio with a focus on leasing those entitlements allows us to buffer the volatility around yields or cash distributions from seasons to seasons, providing more stable annual yields to investors. And this is supported by increasing demand and capacity to pay for water by those irrigators. Lastly, as highlighted here today, in our view, the fundamental long-term drivers of water that have delivered that strong performance over the past decade remain in place today, and we expect them to continue to support values of water entitlements into the future. Thanks, Matt.
Thanks, Michael. And remember, keep those questions coming in because David Wright from Zenith will be asking them in the Q&A session at the end. Well, turning now to emerging strategies, and studies have shown that strong outperformance can be achieved by accessing early stage investments. Equity income investing has been around for a long time, but recent returns from so-called income stocks have been disappointing. So Solaris has devised a fresh approach in this regard. To talk to us today about this, we have Sean Martin, Chief Investment Officer of Solaris. Sean has over 20 years' experience in the finance industry. Prior to establishing Solaris in 2008, he was part of the 9-person Suncorp team responsible for managing equity investments in excess of $5.5 billion. Sean, welcome to the program.
Great, thanks Matt, great to be here. Okay, sorry, I was waiting for you to continue. That's not the order of the day. So it's really good to be back at another summit, albeit a virtual one. I think you'll all agree that Pinnacle's done an outstanding job getting it together in the circumstances. So really great to be able to introduce our Australian Equity Income Fund. It's a pretty big day for Solaris. We've in our 13th year and only had 2 products launched so far, so we don't exactly flood the market. And indeed, this is our 3rd product. And the launch is very exciting for us, as Matt introduced, because it's a very interesting time to have a go at a product suite that is under a lot of pressure. So we're trying to do it a little bit differently, would be my summary. And further to that, the title hopefully sells the story, which is the old way simply is no longer working. When I say launching the fund, I should clarify that just a little. We have indeed run this fund for 3.5 years with seed money, being both staff and Pinnacle money, and we've achieved both our yield and our capital objectives, our alpha objectives, about which we're very proud. But the same 3 people, and maybe this is indicative of the lack of action up here in Brisbane, but the same 3 people ran a very similar fund in the 2000s for 5 years, myself, Lorana Cito, and my colleague Bernard Machin, for Suncorp. So we're not new to the space, but we are astounded at how much the space has changed over that period, and hence the need to do it in a new way and shed the baggage of the past, which is the theme of the chat. So let's hop into it and have a look. This is a very quick overview. I won't labour the point, but this is our 20-year track record at Solaris, rolling 3-year numbers, and our hallmark is the consistency of the performance. Indeed, we've outperformed in 16 of those 20 years, and we're very cautious about what and when we bring to the market. The core product is the one pictured there, a 20-year track record. The Long Short Fund has been very successfully launched over the last 5 years, and this indeed is our latest, and there won't be another one for some time. But the reason we have that core performance chart is that all 3, or the 2 new strategies, inverted commas, are anchored to core. They're extension products. We don't recruit new teams to run the new product. We stick with core, and the same process, the same people, and the same alignment is therefore replicated across all of our product suite. And indeed, we get to, I don't know what's the word, pinch the IP of core, and indeed, hopefully, and certainly the track record to date is indicative of this, get the consistency of returns that we've enjoyed in the core product. We start with core, we modify it to maximise yield, and interestingly, there's only 4 or 5 stocks in any 12-month period that are actually different from core. So if core wins, the other products win, and we like that all-in approach. So I won't labour that point. If we move to the next slide, excuse me, let's have a look at why we think the old way is no longer working. These are 2 portfolio returns for exactly the same portfolio, and that is the traditional yield sectors of banks, which we put in at an arbitrary 50%, REITs we put in at an arbitrary 40%, and Telstra for the remaining 10%. And it's a fascinating chart. We've got that performance for the last 3 years on the left in the red, and it should be in red because it's been very disappointing. And then that performance of the same portfolio on the right in blue. Now that shows the previous 8 years. So the 8 years of returns of that portfolio to the 30th of June 2017, the exact same portfolio. And interestingly, despite the market difference in the 2 graphs outcomes, the yield was achieved in both cases. So the one on the left despite having a chronically inadequate outcome, actually achieved its yield objective. The entire delta was in the capital. And this is the oft ignored part of the income fund world, that you need to chase yield irrespective of what the capital outcome is. And of course, the investor doesn't want that. And the investor's been very disappointed, as Matt alluded to, in this space because of it. If I turn around to you and give you 5 to 6% yield, but chew up your capital by 40% in doing it over 5 years, you're going to be very, very unhappy, and rightly so. So what is the solution? Well, we must seek new sources of yield, and I suppose the colloquial way of saying that is shedding the baggage of the old. The old ways no longer work. One must look to more innovative, dare I say creative, unexpected, unlikely candidates to achieve what we think is very achievable, the nirvana of both yield and capital objectives. And we don't think, I was talking to someone earlier in the day who asked whether we preferred yield or capital. I don't think you have to choose. You can be pretty greedy if you ask me. And certainly this fund has achieved that. So let's have a look at a few unlikely candidates and how they've gone. BHP, well, you know, if you had any eye for history, you would be somewhat shocked that this is my first example of a yield generating machine. BHP, former BHP investors and or executives might roll in their working metaphoric graves if they heard that, but the numbers are the numbers. BHP over the last 3 to 4 years has produced 7.7% per annum yield, while also giving a total return of 17.2% per annum. So it has achieved both of these objectives, and indeed has been a very large part of our income portfolio. We liked BHP in the core portfolio, and we liked it even more in the income fund. I mean, you might ask why we didn't own Fortescue. Well, you know, I wish we had have owned every WAC stock and every FANG stock, but we didn't. So, you know, one must be content with what one has in the portfolio, and BHP has made us more than content. I bring up the example because it is so unlikely that Australia's largest miner would be introducing this section of one's income fund presentation, but here it is. And the reason, well, the last resources downturn saw a very large change of behaviour for the large end of town, not so much the small and middle-sized miners, but the large end of town suddenly were shocked into changing their CapEx behaviours and allocations. And suddenly, in a very uncharacteristic fashion, we saw off-market buybacks, increased payout ratios, special dividends, and all these nice things that an income fund really enjoys coming from the country's biggest miner. So it does not matter. You can't bring stereotypes to the table. You just need to look at which companies are doing what and ignore the past with respect to a stereotypically healthy income fund participant. BHP has been fantastic, and we continue to see it. In fact, has one of the higher yields at the moment in a forecast sense, well above 5% fully franked. So we're not going anywhere with respect to that register. If we move forward, again, a investment bank is probably more likely, it has the word bank in it, but indeed unlikely to be one of two case studies for an income fund. And our whole point is you just need to look beyond the traditional sources, be open-minded and invest in the companies irrespective of their categorisation or their history or what one perceives as a stereotype, and simply invest in those that indeed pay the dividends, and Macquarie does. It's had both, like BHP, a very high average gross yield over that period that you can see in the graph, as well as an excellent average total return. And put simply, growth matters. Macquarie Bank has had close to, I think it's 17-18% compound EPS growth, CAGR, over the period of time since listing in 1996. And that puts it up there with some of the best growing companies in the country. There's one big difference. The perception of risk sees Macquarie at a mid-teens multiple rather than the 40 times plus, 80 times plus, 100 times plus that we see some of the tech stocks enjoy. And equally, Macquarie pay out a large amount of their profits in yield and makes it, again, a candidate that we like. Now, it had a profit downgrade earlier in the week, which was fantastic timing for my presentation. I really enjoyed that. And but I reflected on it, and it is like the reason the stock hasn't crashed in response to that is that many stocks are enjoying the luxury of folk looking across the valley. In first half 2021, is that indicative of sustainable earnings? Well, in many cases, the market has said, no, it's not, across the reporting season. Indeed, they said, no, it's not for Macquarie. We can see some real logic in that. Macquarie has 3 or 4 businesses that are cyclical lows, aircraft leasing, the M&A, IPO business, and also organic growth and funds management and the like. Excess capital, very well managed, and a long history of under-promising and over-delivering. So we're very comfortable still with Macquarie Group, both in the core portfolio and particularly for this chat in the income fund, and believe it can, like it has, achieve the twin goals of both capital appreciation and attractive yield. The next group of stocks is a little bit more punchy. I mean, these are stocks that historically have been looked at as zero yield payers. So why am I highlighting them? Well, these are the growth stocks in our portfolio, and as Michael Bell, my colleague, referred to earlier in the week, we're not growth or value. We are a core style neutral manager that does not need to choose between growth and value, and that bet at the moment is largely neutral. But I'm highlighting these because of how well they have done for the capital side of the equation. Each of them has only got about a 2% yield, some a little bit less, some a little bit more. But Appen, for example, has been a 7-fold performer, 700% over the period for 3 years that I'm talking about. Northern Star, a gold company, is 200%. CSL is up 150%. These are the stocks that you can see in front of you that, while also unlikely in their inclusion in an income fund, have anchored the capital growth of this portfolio. And I repeat, one doesn't have to choose in our mind. To reiterate, this is a portfolio that has indeed achieved its yield objectives over the last 3 years, despite having a whole bunch of names that you've seen me refer to as very unlikely candidates. So we'll just double down, if you like, on this very point. The most extreme example of all is Telstra versus CSL. If you were smart enough, on the one hand, to invest in CSL when it listed in the mid-90s, and misfortunate enough to invest in Telstra when it listed a few years later, both companies spun off by the federal government, your first investment in CSL will be up a staggering almost 400-fold. Your second investment in Telstra is down 20%. They both listed, amazingly, with a similar yield. You can see there on the right. But if you had as I say, kept the investment the whole way, then the current dividend divided by the IPO price, so your purchase yield, if you like, is a little bit under 5% for Telstra and 266% for CSL. So, growth of both capital and yield must be considered. CSL is a stunningly successful yield stock if you bought it at IPO and you haven't changed. So growth really matters. People tend to look at these things in isolation, 1-year windows. And this is the most extreme example of how that can give you a false read. Growth matters, and growth indeed enables a company to provide a very good yield if you're smart enough, as in CSL, to hang on to the position. I don't know too many people who've hung on to CSL to be a 400 bagger, but I'd certainly like to interview them. We have another challenge, which is not to be underestimated in any way, and that's illustrated in this graph, COVID-19 has seen companies, some forced, like the financials, and some just through prudence, slash their dividends. And the need to employ new tactics and be very innovative, creative, delve further and wider to discover yield without taking risk, just not look at traditional areas. And that's become more necessary in this COVID climate. I mean, the graph there, the blue line shows how many companies in this 2020 period have reduced their dividend and how many have raised their dividend. And the red line is cutting dividends and the red's going the wrong way, where almost up to 70% of companies have actually reduced their dividends. And then the blue line is equally going the wrong way to round out the net zero at 1. So 30% of companies have raised their dividends, very few. And if we are just defaulting to the traditional, we're going to fail miserably. The stock I highlight there is one of the very few stocks that has not reduced its dividend and now has a 6.7% fully franked yield, is Horizon. And we've owned the stock for a long time. It's very well managed by Andrew Harding up here. And our journey in Horizon has had good and bad, to be fair. There was a period where they weren't allocating their capital well, but they have changed and now run a very conservative approach to expansion and payout ratios at 100%. They buy back their stock. Admittedly, at the moment, it's an on-market buyback, but it could well be a lucrative income fund off-market buyback over time. And the number is pretty impressive at 6.7% fully franked. But we don't believe you have to sacrifice capital to enjoy that yield. In fact, we believe that Horizon has some capital upside. So you need to look further and wider and with more creativity without the baggage of the past, but this does make it challenging. I'd quickly reassess that. It challenges one only in the short term. We don't think this will be a dividend environment that will be enjoyed or struggled with for many years. In fact, 22, we think 21 will be very tough. 22 will come back quickly and 23 even further in a payout ratio sense. That's all I really wanted to talk about today. To summarise what I've said, and I have repeated myself a lot, so hopefully the message gets through. You're probably bored with me saying it already, but growth matters, and you don't have to choose. Yield without capital preservation is simply not an option, and you wouldn't need to go far in your client base to understand that. And we believe you can get both, but you can't get both by employing the old ways. They are no longer working, and the traditional yield sectors are value and dividend traps for ours. I'll just leave you there with the performance of the fund since inception, and we're happy to say that it has indeed achieved both of our twin goals. Thank you very much for your time. I hope you gained something from the presentation, and I hope you enjoy the rest of the summit. Cheers.
Well, thanks, Sean, and apologies for the confusion there at the beginning. You know I'm always up for a chat with you, so perhaps we can get on the blower this afternoon. Okay, let's turn now to our final speaker, who is going to present another early stage investing idea that could fill a neat niche within your global equities portfolio. Gino Rossi is a portfolio manager with Spheria Asset Management. In his almost 20 years of investing, he's covered Australian and global equities, both large cap and small cap. At Spheria, he's the portfolio manager for the Spheria Global Microcap Fund. Gino, welcome to the Pinnacle Virtual Summit 2020.
Thank you, Matt. My name's Gino Rossi. I'm the portfolio manager for the Spheria Global Microcap Fund. Global microcaps is an asset class you most likely don't already own. It's an emerging asset class overseas, but in Australia it's not well known at all. But we think the asset class offers superior wealth creation opportunities. I should define microcaps first. So we're talking about companies with a market cap below US 1 billion. So, in a global context, everything is larger. Excuse me. In Australia, large cap is CommBank or Woolworths. Globally, you're talking JP Morgan, Walmart. And likewise, when we say microcaps in a global context, they're more akin to a small cap in an Australian context. So please keep that in mind. Nevertheless, we are down the market cap spectrum as far as global funds go. And as you go down that spectrum, we think there are real advantages for investors. And I want to take you through a few of those today. First, though, disclaimer, just to build the juices and get the anticipation going. Please take a moment to read that. Okay, so microcaps are the best performing segment of the equity market over the long run, both in the US and the UK. And you may not have seen this chart before because it doesn't suit a lot of managers to show you, but you would expect microcaps to be the highest growth segment. They're small, they're nimble, they're growing from a low base, and often the founder is still involved in the business, driving that business forward. The kicker is also M&A targets. They're often taken over. So early in our fund's inception, we had a couple of stocks taken out by private equity. Obviously, large cap, mid caps are much less likely to be taken over. This next chart shows from left to right in market cap. As you go down, you get increased dispersion. So you get bigger winners and bigger losers. You get these longer tails. So as stock pickers, that provides us more opportunity to add alpha. Also, you're talking about over 16,000 stocks in our universe to choose from. So we can set a very high bar. There's a lot of dispersion, and that's why I call this stock picker's paradise. It really is a great place to play for a stock picker. This next chart talks to the interest in the space. So microcaps are largely undiscovered. So you look at an S&P company on the right, and on average, there are nearly 21 analysts covering each stock. Amazon has 54 recommendations on Bloomberg. Go down to microcaps, and on average, there's less than 2 analysts per stock. Normally, these are regional brokers, and 39% of the index has no coverage at all. So you type the stock into Bloomberg, and you won't even get a consensus. So this acts as a very big barrier to entry because if you're going to do work in a stock, you need to do the work, you need to look at the accounts, you need to talk to people in the industry. You do not have 21 analysts spoon-feeding you information. You don't have a consensus and their numbers to look at. The other thing is it means we get great access to management. So we're normally speaking to the CEO, CFO, often the founder of a company, whereas in a large cap, you're talking a third or fourth member of an IR team. Even for large fund managers, it's rare to get direct access to the CEO of a large cap. So I spoke earlier about microcaps having the best returns over the long run. But microcaps are interesting because they do have their own little rhythm. And what we find is that a lot of outperformance comes at a time when the economy is accelerating. And so in this chart, the dotted line shows the change in the US manufacturing PMI. So effectively, it's a rate of change in growth, the second derivative of the growth. And so as things accelerate, you can see the dark line, which is global market cap performance over and above large caps, they outperform. So as the economy picks up, global market caps tend to outperform large caps by a variation of 10 to 15%. Is quite meaningful. So if your view is with COVID, and it's very much choose your own adventure, but if your view is we're going to recover from COVID, there's going to be reopening and things are going to return more or less to normal, then in that environment, we're pretty confident microcaps will continue to outperform large caps. More generally, microcaps are a great way to play an equity market bounce. So on the right, you can see the GFC, perhaps the most extreme example, but the top line is microcaps, indexed from 1, and you can see very material outperformance of smalls and large coming out of the GFC. On the left is March, the COVID episode, no different. Microcaps coming out of March have outperformed small, large, emerging markets. And, think December 18, think 2015, anytime there's been a correction, microcaps have always led the bounce out. So aside from that sort of long-term performance that it gives, I think it gives you a nice tactical arsenal to add, which is, if you want to buy a dip, if you want to add more to equities and take advantage of a correction, think about microcaps. They really give you that extra leverage coming out. And despite that recent outperformance since March, in this table you can see that the multiples in microcaps are still very low compared to smalls and particularly large caps, and despite that better earnings growth. There's 2 areas where microcaps are let down, that's free cash flow and the strength of the balance sheets. You can see the balance sheets aren't as good as large caps. But for anyone that knows Spheria, that is the hallmark of our process. We are very focused on companies with good cash flow. We're very conservative with gearing. And so you can see the portfolio on the left certainly addresses those issues. And to labour that point, in this chart I'm showing free cash flow yield along the x-axis. The portfolio is in the blue, the index is in the grey, and you can see a clear bias towards companies with strong free cash flow. Likewise in gearing, you can see net debt to EBITDA along the x-axis, and you can see the portfolio in blue, the index in grey, where as you go left, you're getting stronger balance sheets, net cash. As you go right, you're seeing more heavily levered companies. And you can see our portfolio squarely on the conservative side. In fact, the portfolio has negative leverage. That is, on a weighted average basis, the companies are net cash. And I should add, during the COVID crisis, not one of our companies had to raise equity. So we're quite proud of that fact. Another trait of Spheria is that we're style neutral. We're not growth, we're not value, we're valuation discipline. We do believe the price you pay matters. We're old school in that respect. But we're not growth or value. We don't own stocks on 5 times, we own stocks on 50 times. It's about a consistent valuation approach, and we don't really care whether you'd label them a growth or value. What that style neutrality means is we think we should be able to add alpha through the cycle. And thus far, that has been the case. So the top line here is the portfolio compared to the MSCI World Micro and Smalls. And you can see in 2019, strong market, the portfolio was able to outperform. During the March drawdown, it did particularly well because of that focus on cash flow, strong balance sheets, valuation. And then very pleasingly, we did what micros do best, which is kick out of that and perform on the way back up. So we feel that we can add value. That alpha should be able to come through in a relatively consistent manner through the cycle. These are our numbers net of fees. And here I want to point out the risk element. So the beta of the portfolio is 0.65. That's an ex-post. That's looking backwards. And again, that beta is low because of that focus on cash flow, balance sheets, valuation. And in fact, the portfolio is relatively concentrated. It's been about 45 stocks. Currently it's 47. The index has over 4,100 stocks. And despite that concentration, we have less volatility than the index. And that is, again, because of that focus on cash flows, balance sheet, but also we have a nicely rounded portfolio. We have a good cross-section of industries, good cross-section of countries. We don't have big bets in tech. We're not macro, we're not thematic. We're bottom up. We have a nice blend of companies, and that shows through in a lower volatility. I'm going to take a quick drink, sorry. Okay, I want to run through a couple of examples about the sort of stocks that I doubt you've come across before, stocks that we feel we've discovered before anyone else has. And the first example is a company called Collectors listed in the US. So we first invested, the company would have been probably sub 200 million US. Firstly, Spheria attributes, great cash flow, net cash balance sheet, very high returns, nearing on 50% return on capital. And that chart on the left, you will see in any Spheria presentation. That is where we compare earnings before interest and tax from the profit and loss, and we compare it to free cash flow. And what we're showing is, well, profit and loss is all nice, but does it convert into cold hard cash? And in this case, it certainly does. And we think that's a great starting point to look at any company. So Collectors has no coverage by any research firm. So you put Collectors into Bloomberg, you're not even going to get a consensus. So it's very much an undiscovered stock. What do they do? Well, they are one of 2 grading houses for rare coins, and they're also a sports memorabilia grading company. And you may say, well, coins and memorabilia, that's a bit esoteric, but rare coin market in the US is around 4 billion per annum, just the US. Sports memorabilia has been estimated sells nearly 5 billion per annum on eBay, so they're quite deep markets. And the nice thing about grading is, well, for anyone that knows about coins, you know that the value of a coin can vary materially depending on whether it's tarnished, scratched, the quality of the pressing of the coin. How am I going to buy a coin sight unseen? Well, I can buy it if it's been graded. And so in effect, it facilitates e-commerce and is a beneficiary of e-commerce. And so really it's a play on e-commerce. The other thing that Collectors is a play on gold. So as the gold price rises, people's interest in rare coins tends to increase, and you see renewed volume as well. The other thing is Collector's is a very US-centric business, so slabbing, as it's known to grade a coin like that, is much less common in Europe and Asia, so there's a lot of growth from geographic expansion as well. Next example I want to give is MIPS. So MIPS is a Swedish company. You'll see that the current market cap is actually above 1 billion, and I want to illustrate the point where they were not forced sellers. The minute the company goes above that micro cap threshold, we don't necessarily exit. We think if there's good upside, we want to keep riding that for a while. And particularly, we want to get to a point where it is discovered. So there's, 7, 8 brokers covering it. The price has gone up. At that point, we're happy to hand it off to someone else. But we're certainly not exiting the minute that a stock gets above $1 billion. Again, free cash flow is great, very high returns, net cash balance sheet. So MIPS is a Swedish safety company. So it's a technology that sits within helmets. So when you test a helmet, it's dropped vertically, and if the helmet meets the standards, you're all good. But in the real world, you may have an accident where you hit at an angle. By hitting the ground at an angle, it introduces rotational motion, and that can tear the brain tissue. So what the MIPS device very cleverly does is, upon impact, the device rotates ever so slightly and deflects that rotational motion away from the brain, and thus avoiding brain injury and saving lives. MIPS sells their technology to all the helmet manufacturers, and if you ride a bicycle, you may already own a MIPS or have at least seen a MIPS in store. They put their brand on the bicycle along with a Bell or whoever's selling the helmet. They're also strong in snow sports, they're strong in equestrian helmets, but really the upside's still to be had in motorbike helmets, where they've hardly scratched the surface. And increasingly, it looks like there's a big opportunity in construction helmets. So we see a business with great metrics and a very long runway still ahead of it. Thanks for your time. To conclude, I want to say that microcaps are a unique asset class with superior growth prospects. They're undiscovered, and we're taking a proven, disciplined Australian process and we're applying it globally. Thanks very much for your time.
Thanks, Gino. Well, now you've heard from 4 portfolio managers, 2 on alternative strategies and 2 on emerging strategies. So let's pull it all together, and it's my great pleasure to introduce David Wright. He's the founder and CEO of Zenith Investment Partners. David is closely involved in servicing Zenith's investment consulting clients with portfolio construction, management, and monitoring advice. And Zenith is on the leading edge of covering emerging strategies and introducing alternatives into their consulting practice. So we're going to take a short break, and in just a few minutes, David will moderate questions for our panel of speakers. Okay, we're just having a couple of technical difficulties while we wait for David Wright. So just bear with us for a couple more minutes while we sort out the tech. Okay, David, I think we've got you online now. Can you hear us?
I can, Matt. And
okay. Over to you then.
Thank you very much for that kind invitation, Matt. And good morning, everybody. Terrific to be involved, to be honest. Almost a bit of escapism from the lockdown conditions here in Melbourne. Look, I think, as Matt said, we are alternatives is very close to our heart. Here at Zenith, we are active users of both alternative strategies and alternative asset classes within portfolios, and always in search of different funds, strategies, asset classes to include in portfolios. Obviously, with a view to either improving returns, reducing risk, or let's face it, hopefully both. I think as a number of the speakers have already spoken about, we clearly live in very uncertain times, don't we? We've got a pandemic occurring that none of us have lived through before. Massive government and central bank stimulus. We don't know how all of that is going to play out. I think also, there is a view that, when we, and hopefully we do sooner rather than later, get a vaccine, that, everything will be good. Do we actually know that, from an investment market perspective? I think it was Paddy that already talked about, we've got a massive disconnect in at least a number of sectors that have been closed down by the pandemic. And the investment markets, share markets have been booming, and yet from a economic growth perspective, things are looking pretty challenged at best going forward. And even if we find, or not if, when we find a vaccine, and as I said, the view that everything will be good on the back of that, may not actually be the case in playing out for investment markets, because we may get a rapid rebound where increases in interest rates may lead to increased bond yields and corrections in equity markets as a result. So I think, clearly we're in a very uncertain investment environment. And it is interesting that in our view and experience, that unfortunately, when that is the case, people tend to gravitate back or to things that they know and understand, rather than fully diversifying portfolios. And again, in our strong view and experience, in times like this of massive investment market uncertainty, you really do need a broad number of drivers of investment returns and diversification in portfolios, not less. And yet that's what we tend to experience in these periods of uncertainty. I think also Michael might have mentioned that, we have high net worth investors, sovereign investors, sovereign fund investors like the Future Fund, institutional investors investing in a number of these alternative asset classes and strategies. And yet, and to be fair, we haven't always had the exposure to those within retail. But now we're getting that exposure. We're still not seeing, in our view, enough investment and diversification in portfolios through, what are sort of terrific strategies and asset classes. Part of that is clearly, and the feedback we get from advisors, is that they're not easily able to explain some of these strategies and or asset classes to clients. And so, I really commend Pinnacle on putting on a session like this. Clearly, as an industry, we can get much better than that, but we do need to provide our clients with more access to these alternative strategies and asset classes. So with that, there's plenty of questions for the panel, and I think I'll sort of throw the questions around to the different panel members to try and keep it, dynamic and interesting. But given, Paddy, that you went first, I think you mentioned that whilst clearly the pandemic is not anything anybody's enjoying, it has resulted in much greater dispersion in stock returns and opportunities. So I guess a twofold question in relation to the short side. Are you seeing and do you anticipate a lot more opportunities for the short side of your market neutral strategy? And how do you manage risk on the short side? We obviously saw some, pretty dramatic falls in late February through March. How do you manage the risk of the short positions?
Sure. So I'll answer the first question first, which is about in terms of volatility and increased stress in the market, are there more opportunities? As I mentioned in the presentation, more volatility will always lead to more opportunities, both on the long side, but most particularly on the short side. And we're seeing that, FY20, we had over 200 fundamental short opportunities. The previous year, it was about 120. We don't short all of those, we only short 20 or 30. And looking forward, we still don't have a vaccine, there's still a lot of uncertainty. And at a point in time, government stimulus will need to roll off. So, there are companies that are surviving on JobKeeper. They can be potential short opportunities. You've got, retail companies that will be rolling off some pretty negative or be replacing some pretty negative sales comps coming up. And then you've got banks and financials with heightened bad and doubtful debt. So FY21, we think there'll be a lot of opportunities there. Again, 200 plus we would expect. On the second part of the question, which how do you manage the shorts? In a phrase, very, very actively, but also very, very carefully. The hardest thing about the shorts is when, say, you're long a company, you're buying, say, A2 Milk, as an example, at $2 a share, the maximum you can lose is your capital, your $100 you've invested. But when you're shorting, say, A2 Milk at $2, the maximum you can make is that $100 if it goes to zero, but the maximum you can lose is potentially infinity. So where it is today at $14, you can actually lose 700%. So the first thing we look at with the shorts is the position size of our shorts are always at least half of what they would be in the long side. So a lot less risk there, and also the breadth of the shorts are much, much wider. But we also never short the fundamental and never short valuation, as I mentioned. We never short a particular theme, so we have a wide range of those. But the last thing we manage it is we always monitor them closely, but our maximum time frame that we're shorting a company for is 12 months. It is earnings, so trying to predict earnings downgrades over 12 months is really just a hope trade in our view. So we generally close the shorts out every 3 or 4 months. So turnover is much greater. And the reason for that is that if you short a company for a long period of time, you get an ever-increasing risk of a takeover, for example, which no one wants when you're shorting. So a lot of opportunities and managing those shorts very, very actively and very, very carefully.
Thanks, Paddy. Look, that's probably a good segue and the stock dispersion, and also to you, Sean, the slide you referred to about you can't rely on the banks for yield in the same way as we have in the past going forward, and you highlighted a couple of other large company stocks. Are you and are we going to have to throw the net further in terms of outside of the sort of larger companies into even sort of the mid cap, maybe small cap in that search for yield out of equities?
Yeah, thanks, David. I think we are is the answer. Yes. The main theme of what we're trying to preach, I suppose, is that exactly what you say, that if that is true and the traditional yield sectors are no longer able to anchor your portfolio, your income portfolio, one must be throw the net, as you say, far wider. But the catch, of course, is in doing so, one must manage the risk. And, there's lots of mid caps and small caps that have that are not known for their payout ratios because they are rightly reinvesting their capital into their future. And we don't for a second begrudge that. But absolutely, there are some. And the biggest point we're trying to make is that you don't just assume that small caps are ineligible, that resources are ineligible, BHP being that example, that while the traditional yield sectors are no longer going to provide what you want, indeed, there are traditional sectors that are considered anything but yield candidates that will provide what you want. So we're not doomsday about it. We just think that you said cast the net, I said delve further. It's the same theme. One needs to remove the baggage of the past, completely open-minded, and just judge any stock for what it has in front of it in terms of both yield and capital. But above all else, one can't achieve the yield objective when you sacrifice the capital to do so. And that is what the traditional yield sectors, unfortunately, have provided, just that. They've given you the yield, but you've lost a lot of capital. So yeah, in short, I think we do need to cast the net further, but I'm not negative about it. I think those candidates are there. They just haven't been really looked at as closely in the past as they need to be now.
Yeah, agreed. To sort of change tack slightly now, Michael, found your presentation on the water fund and the water market really informative. Clearly, it is an asset class, as you said, that's been around forever, really, but not well known by the retail and advisory market. What are some of the fundamental drivers of water entitlement values, and how does that lead to sort of lower levels of correlation with the other major asset classes in your experience?
Yeah, thanks, David. In our view, 4 key drivers. So we've got annual demand from crops. So that's irrigators demanding water on an annual basis for long-term investments in their operations. We have the second driver at agricultural commodity prices. So this is demand from our trading partners, where we've had good competitive access over the years, and despite some current hiccups, we expect we'll continue to have good demand for Australian food and fibre. Thirdly, productivity gains. Australian farmers have been incentivised to deliver productivity and search for productivity, and that's meant their capacity to pay has increased as well. And finally, that supply of demand is limited and in fact reducing if you consider climate change, reducing the amount of inflows that we could expect. When you add all those together, you can see they're not correlated to your traditional investment classes. They're really focused on the Australian agricultural sector and the markets that it services, and hence we've seen those low correlations over the last decade or two of water markets.
Thanks, Michael. Gino, I thought you presented a really interesting slide in terms of the performance of global micro over the large cap indices. Or larger cap indices. In the Australian market, as we know, both the small cap and micro cap indices are full of, well, not full of, but have a lot of rubbish in them, to coin a technical term. And as a result, most managers are actually able to outperform the benchmark, most active managers. Is that also the case in the nature and makeup of the global microcap index? And is it a space in which active managers have a really strong record of outperforming?
Yeah, no, thanks for that question, David. It's a good question. I mean, yes, there is a lot of quote rubbish, but when you look at it, I mean, the sector allocation within micros is not too dissimilar to large caps. The only area where you're kind of missing out is consumer staples. You don't have, the big Heinz of the world and Mondelez of the world. But aside from that, I think it very much replicates the large cap space, except smaller. I mean, obviously, there's a lot of companies that are not yet profitable, not producing free cash flow. So, in terms of that, yes, there's less than in large caps, but certainly a sector split is similar. For us, though, I mean, it's really about cutting through the universe and looking for those Spheria characteristics of cash flow, the returns, good industry structure. And so we can largely ignore the stocks, but because we do have 16,000 to choose from, we can set that bar very high. In terms of where there's a track record, I mean, that's the thing. I mean, not many fund managers offer a global market cap product. And of those that do, they haven't been around that long. It is a very niche specialist skill. I think the problem is often that, it's capacity constrained. You can't run, a big fund. So it really is the job of people who are passionate about smalls and micros to launch these products. We have to travel, we have to hire a team to do our own work. It is an expensive product to run. So in terms of track record, look, the signs are it is good, but there's really only 3 or 4 other managers around the world trying to tackle this. And that's what excites us about this product. It's very much undiscovered, makes a lot of sense, but fewer on it yet.
You're right, it certainly does seem to make a lot of sense. How do you go about, as a small team, covering what must be, a massive universe? Do you use a filter process to identify stocks that you're interested in and do more research on, or how do you go about it with a small team?
Yeah, as I mentioned, we are very focused on the stocks we're after. I'm very proud of our screening. I think, we use multiple databases. There's 4,100 stocks in the index, 16,000 in the universe. So it's a lot of data. We have a data scientist to work through that. We can look at trends, not only static points in time, to really pick out those Spheria characteristics in a stock. We also use machine learning to improve our screening, so we can feed back what we like and don't like into the algorithms and improve what the machine learning spits out. So I think our screening is very good, but ultimately it comes down to just being very focused. Our approach is quite different to your typical small and micro manager. A typical manager will say, we've met with 500-600 companies, we've kicked a lot of tires. That is not our approach. Our approach is to be laser focused on the sort of company we're after, do a lot of work on that company, so depth rather than breadth, and do it in a fashion that's very formulaic. And I'm quite proud of the fact that we also focus on things that I think small cap guys often gloss over. Reg risk, currency, what are you short, what are you long, commodity risk, ESG risk. So the process is very encompassing, but it's quite disciplined, it's tight, and that means our analysts are very efficient. And the other thing I'd say is that, as opposed to a local or regional manager, we don't really have to worry about stocks we don't own. If you're a local manager, you do have to worry about stocks you don't own that are large in the index, because that can hurt your relative performance. Whereas our index is 4,100 stocks. The largest stock is 0.2% of the index. So we don't really have to keep an eye on anything we don't own. It's a much purer form of investing. So I think, a combination of focus, I think combination of technology really means we're covering it really comfortably and finding good stocks.
Paddy, if I could circle back to you, one of the promises, for want of a better term, of market neutral managers is exactly that they are, and the returns are neutral to that of the market, or neutral market exposure. Again, in our experience, at times various market neutral managers do demonstrate some beta to the market. How do you and your team and process guard against that and remain sort of true to label as a market neutral strategy?
Yeah, thanks for that. I've got to say, our risk guru, Justin Gray, could write a book on how complex it is to manage net market exposure and beta through stressful or market stress times. But the key thing we do is we really want to understand where our risks are. And the key thing we want to do is push most of our risks into idiosyncratic risks or stock-specific risks. That's our bread and butter. That's what we're good at, not these thematic risks and the likes. We want to reduce those. But you are right, in times of increased stress, your beta can and does drift up, both positively and sometimes negatively as well. And that is the difficulty of a market neutral fund, is what's most important in times of stress, net market exposure or beta? Because through normal market times, you can get both pretty close to zero, or it's quite easy to get them to zero. But in stressful times, you've got to choose quite often between one versus the other. We always choose net market exposure of zero. And the reason we do that is through experience through the GFC in March 2020 of this year, where you get a number of correlation of 1 days where all stocks fall or all boats sink all together.
Yeah.
If you've got net market exposure of zero and beta as close as you can to zero, you'll probably do okay. But if you've got net market exposure of, say, 50%, which most market neutral funds in Australia have, but observed or predicted beta at zero, when you get one of those correlation of 1 days, all boats sink, you will underperform. So through the month of March, a net market exposure of 50% when all boats sunk and the market was down 20%, almost certainly that manager would be down 10%. But you are right, betas will drift up, and it is a good risk metric, but it does have flaws, but it provides a lot of insight for scenario testing, if you like, which is what we utilised through the beginnings of COVID in February, where we created COVID betas for all our stock holdings plus all our portfolios to work out whether we're overexposed to an improving virus outcome or underexposed to that. And we found out very early on that we actually were the wrong way. We're effectively overexposed to an improving virus outcome, which clearly at the time was wrong. So our risk short algorithm quickly repaired that, left tail risk, if you like, to fix that. But through time, betas will go up and down, but market stress, generally they will drift up. You would have seen in our portfolio, we've had net market exposure 0 all the way through, but we've had positive beta of 0.05, 0.06 or even 0.08. And that was mainly achieved through June and July when we had a lot of recap opportunities and IPOs and the like, and most of them were in the mid-cap or the small-cap space. Generally, those companies have higher beta, therefore, if we're going overweight those companies, we'll have slightly higher beta in the fund. Both are important. Net market exposure, in our view, are much more important through stressful times. Normal times, you can get beta to 0. Other times, as long as it's plus or minus 0.1, we're very comfortable with that level.
Yeah. Thanks, Paddy. Important feature and characteristic to understand of market neutral strategies and Firetrails in particular. Michael, you talked to the demand for water by a number of the agricultural commodities, and clearly there's strong demand for all, or at least some of those agricultural commodities by China. Given the recent tensions with China, what impact is that likely to have, do you think, on the water market, the water asset class, and how exposed is the asset class to the fortunes and the political tensions in China?
Yeah, thanks, David. It is a relevant question. Australian agricultural commodities exported to China account for circa 30% of our total exports. So to say we're not exposed is unrealistic. I think what we like about the water market is it's a real diversifier. Now, to give you some examples of that, the current crops that are really impacted are beef and barley. So neither of those crops are irrigated crops. They're dryland or broadacre crops that really don't demand a lot of water. So to date, no impact on the water markets. The most recent crop that came into question is wine, and obviously the function of that is wine grapes. So there's an inquiry by the Chinese into exports of wine grapes, and that is an irrigated crop. And it's competitive for water as well. But to give you an example, we have deep and broad markets across our ag sector complex. So if I use citrus, for example, 15% of Australian citrus products are exported to mainland China. But behind that, we have 35 to 40 deep and broad markets that include Japan, Korea, Taiwan, Thailand, Middle East, all evolving and all growing at different rates and quite exciting rates as well. The beauty of water is it flows uphill to wherever that highest returning crop is. So if wine grape drops out of the complex, another one takes its place. So in short, yes, there's some exposure. I think when you look beyond the immediate headlines, being in water allows you to diversify across those markets and reduce that exposure quite substantially.
You also talked to, and had a chart actually, on the regulatory framework that water and water rights have operated in over time. Again, for the lack of those of us with lack of knowledge in the market, how heavily regulated is the market, and has that regulation been stable over time? Can we have confidence in government regulation of the water market?
Yes, I think in short, you can have confidence. It took a long time to reach agreement across states and at a federal level to put the Murray-Darling Basin Plan in place. It's been tested through both political cycle, climatic cycle, ag booms, ag busts, bushfires, etc., and it hasn't wavered. We've had reviews from state governments to Productivity Commission to the most recent one, the ACCC review, and without a doubt, all of them have been broadly supportive and positive of the regulatory framework in place. Now, they've had sensible recommendations, which we agree with. We contribute to these reviews as well. And those recommendations are around data accessibility and visibility, so transparency. I think with any of these markets, there's a non-zero risk, but we really think the risk is really quite low. And I think underpinning that is the fact that 90% of the water entitlements on issue are actually owned by farmers. So any change to the regulatory system actually impacts more on the core constituents than it does on, say, financial investors such as ourselves.
Thanks, Michael. Sean, has the onset of the pandemic resulted in a material level of turnover in the portfolio? You sort of mentioned in your presentation the changing nature and also increase of companies cutting dividends. So do you see portfolio turnover, or have you experienced higher turnover, and do you expect higher turnover in stock names going forward?
Thanks, David. Yes, is the answer. And it was a pretty passive strategy, wasn't it, for decades? You just went along those couple of sectors and enjoyed the fact that the banks paid their divvies at a different time in the year to the most of the industrial and resource companies, and so you got two bites of the cherry, and that was it. You rotate into banks and rotate back and get a fantastic outcome. The answer is absolutely. You've got to be more. You've got to delve further and wider, and look harder for appropriate yield candidates, and that does require more turnover, and that does require a far more active strategy than has ever been the case. It's always been an area that has, I can't think of another area of the market that's had such a long period with the same tactic being so successful. But like all these things, when it turns dramatically. The first was the underperformance of the banks and Telstra. Well, not so much Telstra, that's probably been around for a while, but certainly the banks. And then secondly, to just follow it up aggressively in terms of the challenge, is that chart that you mentioned showing how many companies are cutting their divvies through COVID. But I'd say the first one, David, is a structural and permanent change. But the second one is more transient, I hope, we hope. Certainly down in Melbourne, I guarantee you hope. It will be, must be driving you completely bonkers to be in lockdown for so long. So, and we've got all your football teams up here, which is even better. So it's painful for everyone. I don't mean to be blithe, and it has definitely increased the challenge in the short term. I think that will normalise. Payout ratios will return. Boards will be less cautious, and indeed some of the impost is a regulatory one, APRA demanding that dividends be cut. But we need to be more, cast the net, as you said, further afield, and I think that plays into the hands of an income strategy that's anchored to a long only and long short portfolio that requires the IP to be spread across the entire market, rather than just a few focused sectors. But definitely turnover will go up, and I suppose with that requires risk management, because risk goes up as you delve down into a broader range of sectors and market caps. So it's much more challenging, I think, this space. That doesn't mean it's necessarily negative, but I think the spread of returns in income funds is going to remain very wide for a product suite that historically has had a pretty concentrated spread of returns across a survey, for example.
Yeah, no, that's a good observation. I certainly think that's going to be the truth going forward. And the weather behind you and Michael in Brisbane looks terrific, just to rub it in. Thanks very much for that. Gino, Given I imagine that microcaps, global microcaps, are, and maybe this isn't the right assumption, but are more leveraged to the economy, the domestic economy in which they operate in, is there a need for, in your analysis and process, an assessment of the macro environment for that country or economy that the company is operating in?
It's a hard question, David. I'd love a Dorothy Dixer at some point. But yeah, I mean, you'd be surprised how many of these small companies are multinational, global. They typically have a niche they're very strong in, and they sell that around the world. We do have some companies that are leveraged to an economy. So, for instance, one of our biggest holdings is utility in Norway. Another one is predominantly Japanese with some export business. I think, one exposure we have a bit is Czech Republic and Poland. We have a UK company and a Finnish company that has some exposure there. So obviously we need to track how those economies do. It was pleasing to see they've handled COVID very well, although Czech Republic's had a bit of an issue of late. Hong Kong, I think, is a good example. We didn't own anything in Hong Kong. We just couldn't get comfortable on a name there. And then the riots were going very strong and hurting that economy badly. As they subsided, we hopped on a plane and went over there in September 19. Spoke to many companies, got a feel for what it meant, got a feel for the drop-off in Chinese visitation and the impact on companies, and came away comfortable to invest in a couple of companies we'd done work on. So for us, macro is more about risk. We're very much bottom up. We're not macro, we're not thematic. So we're not going to turn around and go, the German economy looks good, let's buy more in Germany. We don't do that. It's all bottom up, and the macro is really about managing risk. And as I said, I think in my presentation, we've got a nice spread of sectors, nice spread of countries, because you've gone down the market cap spectrum. I think the last thing investors want is for us to start punting on macro and thematics as well. We're going to stick to our knitting, and we think the alpha will come from that bottom-up analysis. So I think we have to be conscious of it, but I think you would be surprised how much of the portfolio has a global reach. I mean, MIPS, for example, which I spoke to in the presentation, they would hardly have any revenue from Sweden. That is a truly global business.
Yeah, you're part of your answer there in terms of the diversification across countries and sectors. And again, you pointed to the difference between domestic or Australian microcaps and international microcaps, but it does seem to be an asset class or sector that can provide some really spectacular returns, but also at times, probably equally spectacular volatility. What are you doing in your strategy to manage the volatility aspect?
Yeah, we don't employ any hedging strategies. It really comes back to that philosophy that's proven over many cycles that Spheria has, which is if you focus on strong balance sheets, valuation, free cash flow, that provides a floor. And so many of these companies don't have a floor. If it's all made up in revenue multiples, where is your floor? So we've found that through cycles, the Spheria process really comes to the fore. And March showed that. The performance, I think we performed in line with large caps. You're seeing moves of 20% in stocks like Tesla. I don't think large caps are quite as safe as they used to be because of all the passive money swishing around. You have to remember, passive doesn't come down into micro. So look, it's nothing sexy. It's really about being sensible. It's about being valuation disciplined, being very conservative when it comes to leverage. I mentioned the portfolio is weighted average net cash. And by having a nice spread of country and sector, we think we're managing risk well. That drawdown was very pleasing because it validated our approach.
Paddy, you talked to the opportunities that the current sort of market environment presents from an active management and investment perspective. Do you envisage that creating more opportunities, in particular for the what you call the events aspect of your portfolio going forward?
Yeah, absolutely. They're obviously very prolific through COVID, but we think they'll continue for sure. At the end of the day, the events is really a relationship game between the fund manager, the equity capital markets group or the broker, and company management. And we work those relationships hard. So we do get to see most recaps, IPOs and pre-IPOs. And as I said, there was 40 plus already But we know with signing confidentiality agreements that there's at least another 10 to 15 coming through to the end of October as a minimum. But looking through to next year, we'll probably have a bit of a breakthrough December, January, Christmas, which you always do in terms of recapitalisations. But there's at least 40 companies in the ASX 200 that we think have too much debt. If we don't get a COVID vaccine, these companies will need to come to the market. You've also got high quality companies, buying out their lower quality competitors. That started already and will continue through to next year. And then the IPO and pre-IPO market will be prolific right through to next year because the access of capital in this market currently is very easy, and also the fairly rich valuations we've seen. Everyone talks about Afterpay as the one buy now, pay later, but there's been 5 IPOs or pre-IPOs in other versions of buy now, pay later in the last 4 months alone. So we think there's going to be an enormous amount of opportunity. And if we get a true COVID vaccine, the M&A market will heat up extraordinarily next year. So events will be very positive picking grounds, if you like, for the next 12 months at least.
Absolutely. A great time for active management. Thanks, Fatty. Michael, again, I think you had a terrific chart as part of your presentation, sort of highlighting the capital growth and income breakdown of water as an asset class. In your experience, can you give us some insight into how institutional investors allocate to water? Does it tend to be more in their growth allocation, or more so in their defensive? Have you got some comments and experience around that?
Yes, David. I think the key comment is there's no consistency across institutions that we've seen, and that's international and domestic. So the broadest group is alternatives, hence the sort of discussion today. We've seen it end up in real estate. We've seen it end up in real assets. Very few have a farmland bucket as such, or an agricultural bucket, some in natural resources. So it's really been a bit of a distraction actually to a lot of institutions. Where do we allocate this unique asset? And our argument has always been, we really don't mind. Look at the asset class on its fact that it delivers consistent yield, the fact that it's uncorrelated, and the fact that it's had a really good capital growth story as well. So it's BYO, pick your own effectively.
Anticipated that might have been the case. Look, we're bumping up against the time constraint now, so hopefully you've found that, I'm sure you found the sessions really useful, and the Q&A. So thanks to our panellists in Paddy, Michael, Sean and Gino, and I'll pass back now to Matt. Over to you, Matt.
Well, that brings our session today to a close. Please remember to click on the CPD Hours icon and complete the survey on your screen. Also, our last session is tomorrow. It's on fixed income with Metrics Credit and Coolabah Capital Investments. It should be a lively session with Christopher Joy and Andrew Lockhart. So thanks for joining us today. We hope you've enjoyed the program, and I hope you have a good day.